All right, Brian Shannon is our special guest lecturer today. Brian, for all of you who know, writes for Alpha Trends, wrote a really great book, which, where's Joe P?
I didn't take it.
We've been looking for my book
Totally not me.
for like a month, and Joe P right there, to blame it on Beta.
Totally beta.
I got another one. I'll give it to you.
And,
Unless he took it out of my bag.
So Brian wrote a really good book, technical analysis using multiple time frames, and was speaking at the Trader Expo with us on the Stock Twits Nation.
Okay. Yeah, I guess that's what it's called now. Reformed broker.
Part of the Stock Twits family, and G-Man apparently didn't get him in too much trouble last night.
He tried.
But we really appreciate you coming in, and Brian's going to share a little bit about what he does every day to make money. Thanks a lot, Brian.
Thanks, guys. Thanks for having me here. I don't claim to have all the answers. I know there's a lot of smart people in this room who are doing well trading, and I'm just going to give you kind of what I look at the market. So I call it trend alignment. I'm certainly not the person that I think invented it, but I wrote a book that was pretty well received, and is still to this day the technical analysis using multiple time frames. I am basically a technical analyst. I guess if you had to put a label on me, I do look at some fundamentals, and Steve was telling me there are three foundations. I think I got it right, or Mike was rather. It was understand some of the fundamentals, not necessarily all of them, and some technical analysis and tape reading, and I believe in that. All three of those as well. I used to have a PowerPoint that I said what makes stock prices move: fundamentals, technicals, and then I said psychology. And really the psychology is the most important part and hardest to quantify, really. But what makes people move? Well, fundamentals are obviously a big catalyst. So you at least have to know when there's news due out, because you get that heightened sense of risk around earnings time, around FDA or whatever. And then the technicals, people will try to explain away. Well, the market was up today. The market was up today 2% because of something Obama said. When we know it just broke some resistance. The Qs broke past 44, and when they got above that level, they had a little hesitation. I guess I wasn't trading today, but this 44 has been, just a real obvious level, and we've come down, showed a lower high, and then these higher lows, this 5-day moving average, which I think is really important for the intermediate term. If I had to say one intermediate term indicator, I guess, of where I want to trade in the direction of this 5-day moving average, and I'll try to keep my head out of the way so you guys can see it. But anyways, we had tested on Friday. Obviously Thursday was a great day. For me, it was a personal one of my better. I think my best day in 2010 so far. But anyways, I was looking at going, the market. We're just below. So I sold a bunch of my stuff. I held little positions. I was like, then the next day we had that gap lower. I was like, nice, yeah. I mean, I was down 1,500 on the open, but I knew it would have been given back some of my profits, but fought back. Anyways, the important thing that I thought was that day is that we had held above this prior little high in here and above that rising 5-day moving average. The market fought back, obviously, and here today, this 44 has been a pretty important level. First, it was this support over here, resistance once, resistance twice, and look at the direction of that 5-day moving average. I don't know if you guys listen to my videos or that sort of thing, but I always constantly harp on what's the direction of the 5-day moving average. Now, there are times when the market, especially on a gap, it'll gap up. Let's say it closed right here on this day. It'll gap up above that 5-day moving average, and the 5-day moving average will be sloping lower. But some really powerful trend days can come if it does that gap higher, kind of pulls back a little bit, holds on, gets above the daily VWAP, and then you get these really nice moves higher, and eventually it'll drag that 5-day moving average with it. It's not like anything. It's not 100%. Oh, well, the 5-day moving average is declining, so I have to, I can't trust this rally. I mean, if you're long here on this day, yeah, you got to be long because the prices are moving higher. But if that 5-day moving average is declining and we're at this prior level of support, you better take most of your profits off if you're long at the end of that day. It just makes sense that here's an area where we would, pull back. most of your profits. Because if we get through it the next day on a gap because of some news, then maybe it's worth holding a little bit long. Do you guys hold much overnight? Yeah. I mean, I rarely do either. I don't really see the need to expose yourself to the risk, especially in this heightened sense of risk right now with this banking stuff, with the sovereign risk, the earnings season right now. We've got a lot of little things that individually are damaging enough, but now we've got this little tsunami of things that are kind of coming together. But if you stay true to the levels and stay objective, you look at it and say, well, this morning we gapped above that 44, we pulled back a little bit, and this is something I was talking to people about at the expo yesterday. Is I like it when a market gaps higher. So we have the gap higher from yesterday. We get a pullback, and that first half hour or so, if it stays below that daily VWAP, and then the daily VWAP begins to flatten out, and it makes like a higher high here, not necessarily the high of the day, the opening range breakout that people play, but right above this level, you say a stop below here. It's never a stop below there, but it's just kind of your safety point where you say, all right, this thing's failing now. You probably, if you're buying at this point, you're probably not going to hold down here. I'm not going to, but I just, for the sake of explaining that you have to have a stop based on something, which is the definition of trend. Where's your most recent high or low? Well, from a day trading standpoint right there. But we held also, we shook out just below that 44 level, reclaimed 44, and then it popped nicely higher. So anyways, I'm kind of rambling right here without a agenda, but I do have this PowerPoint that I created and used yesterday. Actually, I used the wrong one by accident yesterday, but I'm going to go back and forth between my laptop didn't even work yesterday. It was kind of a disaster. This was the book, and I'm on Twitter as well, but this is just kind of a basic type of thing. I don't know if it's a little too basic for you guys, so forgive me if it is. But you look at the market and you say, well, we're in a bear market or we're in a bull market or whatever. I mean, really, who cares, right? It changes every day. On any given day, we can have two bull markets and a real beautiful bear market. I mean, it's true, right? I mean, you can really make some great money on both sides of the market. So putting these labels on it doesn't matter. But this is what matters. It's opportunity. This is just something that I had put together at the end of last year. That I took every single day of the last 12 years or whatever. Yeah, 12 years. So going back to 1998, and I said, what's the average of every single day based on low to high for the day? Well, in 2008 and 2009, we had the biggest. We had almost 3% daily range in the spiders. 3%. I mean, a CD will pay you 1%, right? It's obviously not that easy that you're going to get it every day, of course, but the opportunity is certainly there. That's the point. The point is, the opportunity. And then I took it and said, of those 120 months, and I didn't line it up perfectly. It was a real pain in the neck to try to get it to overlay these two charts, because one I created, I think, this one is in Excel, and I took this chart off of, the Realtick, which is the platform I use there. But anyways, these are the 25 largest ranges. So October of 08, the range of the S&P 500 was 28.7% in 1 month from high to low. I mean, if you can't find an opportunity to make money in there, or get killed, it's either way. It's just, I mean, you're either going to be making a lot of money or you're just done. I think in that type of environment. But the beautiful thing is that there's all this. It represents opportunity, but it also represents an incredible environment in my mind to really learn. If any of you are newer traders, to learn in just this historical volatility. I mean, it's really and here, if you talk about bull and bear markets, well, we've had since 1999 we've had two beautiful bear markets. one phenomenal bull market, and this, people are saying, well, I still think it's a secular bear market in a cyclical bull. What the hell does that mean? I mean, we've had a 60% rally in the S&P 500 off the lows. That's not a bull market. Call it a bear market all you want, but there's been some fantastic opportunities on the long side. So anyway, that's just kind of some interesting, useless information. But the point is the opportunity is there. People can gripe about high frequency trading because it's annoying as well. But you've said you have to adapt. Things are going to change. When we went from fractions to when we went from fractions to decimals, or we went from quarter point spreads to eighths, then to teenies. They were like, oh wow, and then it was the So's bandits and the island. There were all these things, all these uncertainties. The opportunity is always going to be there. The high frequency algorithms that get in the way, they're a pain in the ass when they're sitting there messing with your trade when the stock should be doing something. It should be going. And what the hell are these bots doing? Hey, you know what? But they're going to be there, but there's still opportunity, and maybe sometimes you have to test that, send those test orders 3 or 4 times, and you wonder, am I being stubborn on this? I've just lost 3 times in a row. Do I go in that 4th time? Am I stubborn or am I persistent? And if you make money, it's like, yeah, I was persistent. And if you lose again, it's like, what a dumb, stubborn asshole I am. Anyway, I mean, everyone experiences all those same emotions when you go through your your cycles of profitability. It's everyone has. No one makes money all the time, but to me the way to make money is trend trading, and it's pretty basic. What is the trend? An uptrend, higher highs and higher lows. Downtrend, lower highs and lower lows. What time frame? Is a 1-minute time frame for today good enough? A lot of times it is, right? I mean, that's I talk to other people about weekly charts, and a weekly chart is kind of interesting. A daily, I think I'll get a little more into it, but a daily chart, I think you want to always at least be aware of where does this stock come from, what's its personality and that sort of thing. But we want to drill down to shorter time frames, and people obviously have to buy after us if we're going to make money long and sell after we short to make money. So we need to anticipate. We have to look at it. Someone was saying recently it's like chess. The great chess players, and I'm not a chess player. I've just started playing with my 13-year-old, so I don't have many strategies, but I can, it's not hard to beat a 13-year-old when he's just learning too. But the point is, I can see 3 steps ahead what he's going to do, and I can trap him, and I can plan it that way. And that's the way it is in the market. You have to think a couple steps ahead. You have to say, what are all the potential scenarios here? Now, a certain type of day, I realize that we're above this rising 5-day moving average, so I might have a bias towards the long side. I'm just going to move this over just a little bit so I'm not. Well, that's fine. So I might have a bias to be long. But if the market starts tanking, it gaps above that 44, it holds 43.90, 43.87, and then turns around, then my bias is, okay, we're probably going to hold 44. That prior resistance, that important level, is going to hold the support. So I want to be positioned for the most part long. The advanced decline line is 18 to 12. It's 20 to 19 to 11. It's increasing. It's getting stronger throughout the day. It's above a daily VWAP. You don't want to be shorting, right? So, but in the afternoon, it could completely fall apart. We get bad news. We get some kind of news that's interpreted as bad. I hate to say bad news because what is bad news? Bad news is unemployment, right? But sometimes we rally on the bad news. So it's the interpretation. But we want to anticipate all potential scenarios, and then we want to wait for price confirmation before we actually participate. Okay, I'm expecting 44. We gapped above it. Maybe we shake out a little bit below that. We're below the daily VWAP. We're gonna, maybe settle in here. We're at this important level. where do I participate? Where does it become clear? You know, it's not always an exact, precise level, because maybe it was right in here where you're starting to nibble along. You're saying, well, it's making a higher low. We're at that daily VWAP. The advanced decline line's strengthening. Maybe the XLF is strengthening a little bit, or somewhere we're seeing some leadership out of the semiconductors. And do you guys talk about that? In here, like, hey, semis are. Do you guys like shout that out and stuff? Yeah, I mean that's phenomenal. I mean that's what Twitter's trying to kind of create. I don't think it's as good as an environment in here where you guys kind of all know what maybe you're responsible for monitoring the SMH, or I don't know if you do it that way. I know some prop firms do, but you start to trust that and to collectively build that intelligence and say, okay, now that's going to give me the confidence to get into either the Qs, or, as Steve had just pointed out, the triple Q we have now, which is just what the market needs, is more 3 times funds. Why isn't that typing in? TQQQ. What's it? Yeah, is it? That's right. I don't need that. Anyways, you get the point. So we want to anticipate all those scenarios, but we want to wait for price confirmation before we actually participate, and then the job is always the same. Alan Greenspan said it 2 or 3. I don't watch congressional appointments or whatever, but it was on CNBC for some reason, and he was talking to Congress as he was getting reconfirmed for another 2 years or whatever his stint was. He said to the Congress people, he said, basically I view my job as risk manager for the economy. I was thinking that's pretty cool. I like that, because a lot of people weren't talking about risk management. You look at another one of these when they had the bank CEOs 2 months ago, they just kept saying risk management, risk management, risk management. And I was thinking, they're throwing all the traders under the bus and they're talking about risk management. I was thinking, newer guys coming into Wall Street would probably, the big money is going to be paid to risk managers. They're always the most hated guys in an office. They're the guys that tell you to turn it off, or you're done for the day or whatever. But it's the right thing if they're doing their job properly. But managed risk is our job. I mean, it's the same as the Federal Reserve. So we're all qualified to run the Fed as well, and that's a nice thing about trading. But the idea is that you have to be almost robotic about it. You have to look at it objectively, unemotionally, and it's easy to say, it's easy to talk that way. But when you're in the triple Qs, or you're in the FAS or the FAZ and you're wrong, the emotions come out. When you put your money in the market, whether it's your money or if it's the firm money, it's money you're responsible for. Your emotions are going to be there whether you like it or not. And when you leverage your capital, you leverage your emotions as well. And if you're not a good manager of your own emotions and risk, you're going to find yourself doing the exact opposite. I've done it before, where I've looked at it and said, I just sold the low, I guarantee it, but I was just too big in here. I couldn't take the heat anymore, and I should be buying right now, but I guarantee I'm the asshole that just sold that low. And we've all sold the low, and we've all bought the high at some point. But these are, you want to, stay more objective and look at the market based on the 4 cycles, the 4 stages, the cyclical analysis. This is Stan Weinstein who kind of popularized it in his book. If you haven't read that book, definitely read it. Secrets for Profiting in Bull and Bear Markets. It was actually, I still can't think of the name of it, but the author was Joseph Kerr, Kerr. And the guys from TradingMarkets.com bought the rights to that book. It was a 1920s book about how prices move or something like that. And he first came up with accumulation, markup, distribution, and decline. He didn't put I think Stan is the one who put the numbers on it, and then and that sort of thing. But it's been around a while, is my point. And to me, it's what has always made the most sense. And this is kind of how I like to view the market and say, where are we? When we have, so I'll look at moving averages. I like to look at 3 moving averages on any time frame. And when we have moving averages crossing back and forth above and below each other, people say, hey, it's a moving average crossover. That, it's time to buy or time to sell. That's the stupidest time to buy or sell, in my opinion, because it's saying that we're entering a period of indecision. We have just come from this beautiful trend where the short-term, intermediate, and long-term, trends, you can view this as a short-term trend, intermediate, and longer-term trend. They were all confirming each other, where they were all good, it was innocent until proven guilty. Right here, it's getting indecisive. We've probably got news, we've got a lot more volatility. It's, the moving averages say the short-term trend is now lower, the intermediate term still up, or, flattening out, and the long-term up. So in these stages 1 and 3, in this indecision, it's time to either shrink to a shorter term time frame, and this could represent weeks, months, minutes. These cycles repeat on every single time frame. But we've got we've got these cycles on the monthly time frames, the weekly time frames. So on on here I'll look at for instance the 10, 20, and 40 week moving average. Okay, roughly they're approximately equal to, and I always like to just to keep it consistent. Red is my short term, blue is intermediate term, and green is long term. So on no matter what time frame I'm looking at, even though I'm looking at different moving averages, they all mean the same thing. Those colors do to me. So the 10 week, 5 days in a week, except holidays and that sort of thing, it's approximately equal to the 50-day moving average. The 40 week is approximately equal to the 200-day moving average. So, those are the ones that people are trained to look at. There's no magic to the 50-day moving average. People think, I always ask. I had a room last night. How many people have a 50-day moving average on their chart? Okay, and I asked them to look around, and 85% of them had the 50-day moving average on there. I asked them, how many of you use an Adams pitchfork on your charts? And out of maybe 250 people, one guy raised his hand, and everyone laughed at him. But maybe it works for him. But the point is, why is the 50-day moving average important? Is it important because there's some cosmic force, like pivot levels, or Fibonacci? Is a 61.8 really the golden mean, and that's the secret to the universe? I have a hard time believing that stuff. What makes more sense to me is, what's the psychology of these moving averages? The psychology is, we have a rising 50-day moving average. You generally look at that stock as it's in an uptrend, innocent till proven guilty. Most pullbacks will recover. Okay, but not all of them. If you look at the S&P, I've been talking about the S&P 500. You don't buy when it touches the 50-day moving average. Some people do, and sometimes you can nail it. Maybe not in the S&P 500 here recently, but around that 50-day moving average, we tend to get some important movement and recovery when it's rising. Well, here it was starting to flatten out, and then we had that 10-day crossing down through the 20. It said, we're not able to get above that 50, but there were people here saying, hey, I'm buying. The 50-day moving average is at 45.20, and I'm sticking a bid in. I'm thinking, that's pretty stupid, dude. It's in a free fall at that point on that day, right? We can look at that day, which was, let's see, so right here, that was the 22nd, and the 50-day moving average was at 44.86. So on the 22nd, at 44.86, we had the 50-day moving average, right, 44.86 right here. I mean, the stock, it's breaking down at that point. We've got lower highs and lower lows, and you look at this 10-minute time frame, we've got a declining 5-day moving average, we've got a declining 20, 50, and 100 period moving average. So I'm talking about, two different things here. I'm talking about 20 period. The period here is 10 minutes. Okay, so I've got a 20, a 50, and a 100 period. And then this is actually a 195 period moving average, because but it represents the 5-day. Okay, does everyone understand how that works? Okay, cool. So, because I always have people say, I put the 5-day moving average on my 10-minute chart, and it doesn't look like yours. It follows really close. I'm like, no, you put a 5 period on there, dude. You're looking at the average of the last 25 minutes, okay, or 50 minutes. Much different. Okay, but so the point is, we're below a decline. I mean, to buy at that 50-day moving average, anyone can see it's breaking support from the morning, and it's in a free fall. It's just stupid. But there is, there are important levels to be aware of because sometimes you get good bounces there, but what's the psychology? The psychology is the institutions that have millions of shares are selling it, and they're saying, hey, sell me down over the next 2 weeks, sell my position down, not to exceed 2 million shares, down to the 50-day moving average. When it gets there, stop selling, basically. So, all right, cool. Goldman starts doing that. They shave a nickel here and there off of every order. You just have obligatory slam at Goldman, right? And it's the popular thing to do. So anyways, the psychology is they say, well, stop selling when it approaches or within 10 cents of that. We have the same thing that happens with the VWAP, with pivots, with all this stuff. Why are they important? Because they have programs built around these. But if we can kind of figure out, well, what are these programs based around? The VWAP is an important one. The 50-day moving average is good for a longer-term chart. So we're saying that some people who are long big positions who've been riding say, sell me down to the 50-day moving average, then stop selling. Other groups of people who kind of miss this move are saying, add to the position, buy more as it approaches that 50-day moving average. So we have less supply and more demand in that area, and it becomes a self-fulfilling little prophecy that, so you don't buy it there. Instead, you look at the shorter term time frames and you say, is there a reason to believe that this 44.86, this 50-day moving average today is going to hold a support? Looking at the 10-minute time frame, you got to be out of your mind at this point. And it's not hindsight. Anyone in this room is smart enough to see this is in a decline. It's stupid to buy that 50-day moving average. Next day it settles down. It breaks past a little bit of resistance 2 days later. This is a day to be long. For in my mind, for a day trade only, because we're below a declining 5-day moving average. And it breaks support. I mean, these cycles repeat over and over. And it just, what time frame do you personally want to focus on? A daily time frame, a 65-minute time frame, and that's become recently a pet peeve of mine for some reason. A lot of people use 60-minute period, charts. Use a 65 because you have 6 equal periods of 65 minutes. The market's open it's open 390 minutes a day from 9:30 to 4. So you can divide 65 into 390 and you come up with 6. Okay, so each one of these candles is 65 minutes long. So if you have a moving average and if you're trying to see what the 5-day moving average is, you're not looking at what you're giving a little extra weight to that first half hour. Basically is what it's doing. You're giving it more credit than it deserves because it's only a 30-minute bar. You can look at the 10-minute time frames, the 1-minute time frame. Then this is just my little joke because I ski a lot and you start seeing these little moving areas. I see little cups and handles in the mountains and all that, double tops and all that stuff all the time. But anyways, the whole theory of trend alignment really is based around really Dow theory. Dow theory. Charles Dow came up with the the Dow theory in the 20s, and he said there's three trends in the market. Basically, you've got the primary, the secondary, and short-term trends. So he defined them as years, and then these ones are maybe 2 weeks to 3 months, and he said insignificant ripples are trends that last 2 weeks. So 2 weeks. In this room, that is the long-term trend, right? So it just depends on what time frame do you personally want to focus on. So what I like to do is I look for, okay, so here we are. You want to combine the time frames. You want to look at that longer term time frame and say, okay, here's my list of candidates. These are set up in a bullish or bearish environment, and look at an intermediate term time frame and say, here's where the bigger levels of support and resistance seem to be over the last 20, 30 days. And a short term time frame, maybe you're going to look at a 10-minute, a 5-minute, a 1-minute chart, and that's where you're making your fine tuning. Then you start to look at the tape. Is it speeding up? Are we at that breakout level? Does it look like it's ready to lift, or is there some supply just not there, holding it back, whatever. So the way I like to look at the market personally is I mainly day trade. That's 95% of my trades are probably day trades. I like to look though for the bigger moves. So in my mind, the bigger moves are from the swing trade setups. You've got a nice trending stock. It's rallied on some heavy volume. It's pulled back on light volume. It's kind of settled into an area, and it's ready for that next thrust higher. And those thrusts higher will often last 3-4 days, let's say, in a good trending stock. So I like to buy, the swing trade candidate, but I typically will end up selling that first day of movement, or I'll hold a small piece, just to say, well, what if it keeps going? Or if I really want to position myself for that, what I think will be a swing trade, I really, in particular, the last 2 weeks of options cycle, like this week and last week, then I'll go to options, because I figure, I can buy, let's say the stock's at $20, or let's say the stock's at $19.75. Last week I could buy some of the February 20 calls for 50 cents, 45 cents. So to me, I'm looking at saying, well, I think if it goes, it could probably go to 21, 22 and a half, could even be likely over the next 8 trading days. Here's my risk of 40 cents. So I'll buy some calls, and then as it starts to break out, I'll buy the stock, and I'll hold the stock, and I like to, I'll trade the stock rather. Sell, I like to buy a big chunk quick, feed some out almost immediately, 10, 15 cents away, cover my, transaction fees and that, and then hold, some throughout, just peel out on strength throughout the day is the way I generally do it. I'm not as good at getting back into the same stock for some reason, but anyway, so that's my style, and so I like to maybe pull enough out of the stock that I can actually have those options for free. So then I can have, like I do now, I've been trading Dendrion. Dendrion happens to be a great one around earnings for some reason, and I don't need the keyboard because I have it over here. I can just click and there are links, so that's fine. So Dendrion happens to be, and this is, I have the subscriber site at Alpha Trends, and it was actually I believe this was, let's see, today's Tuesday, Friday, Thursday, Wednesday. It was last Wednesday. I had said to subscribers, this Dendrion getting above this 29.55, I believe it was. I said, I think it's going to get going again. It's up at these, I'd made some money off this run, and the daily time frame, we're up at, we've been knocking at these highs. We've had that test of the 50-day moving average. We had a higher low, and these are all-time highs. It's a stock that, so I said, we want to buy it above that level. And I said, I'll probably put my stop around here, but worst case stop, I said, was 28, whatever the low was that day, though. Because I said we wanted to buy it on that move above there, and what I suggested was as a stop was the absolute low of the day. It was just bad luck, and I said, well, I bought options actually on this day, and I told them, I said, listen, I own some options. I'm going to hold them, but I'm also going to think I'm going to be trading the stock tomorrow. It looks like it's getting ready to go. I've been talking about these options, and anyways. So, I held the options, but I couldn't hold the stock down through that, and I didn't want to short it either. And it rallied back up, and the next day it took off, and I actually bought the stock again because I was figuring, all right, well, that was the fake move. Here comes the real one. And even a lot of subscribers they don't understand. We're gonna buy that again? Dude, that sucked. Why? I hate going down that block. That bully always hits me, But yeah, we're going down that block again, but we're going to kick his ass this time. Come on, I promise. But you can't promise, of course. But anyway, so we came down, and so now we've got this beautiful rally. I'd sold part of the calls, and I'm still holding some of the calls, and it's free money now. That's the only position. I didn't trade at all today. Thank G-Man for that. Actually, not thank him, but I think he's got a reputation around here. He was not the influence. But the point is, I like to look for the swing trade setup, and then I generally will day trade the stock. And if in particular last 2 weeks of option cycle, I like to hold them for that. I do not trust Dendrion to hold the stock. I almost never hold the stock overnight. It's just, to me, it's just it's really one of the stupidest stocks there is when you have this day. And I was telling Steve the other night that I had on this day when they had news, it was down. it was coming back up from that $8 level, and in my IRA, I was like, all right, I'll take a hit and see how it goes, you know. Anyway, so I did 200 shares. I was like, all right, it's going a little bit. I'm going to buy another 200. And I did something on my keyboard, and I accidentally bought another 2,000 shares. So I had 2,200 down at like 1365 or something like that. And then as soon as I looked at my position, I was like, that's 2,200. What the hell? How'd that? And all of a sudden, it froze. Halted. I'm like, oh shit! No way. This thing's gonna. It was just 8. I bet you it's going back. It's got to open at 8. Instead, it opened at 24 and change in the after hours. And I just sold most of it. I mean, it was just complete dumb luck. But anyways, it's a fun stock because it makes some big moves. And I had actually, I had caught this. This was on an option cycle as well. And I tweeted the entry as well. But I bought some calls at about 25 cents. And I sold them up at, I don't remember the price, but it was like 1,600% 3 days later. And those are just fun to... I mean, it wasn't a huge position, but 16%, 100% is just, those are just fun. You know, they're good. They're good stories. Anyway, so before you enter the stock, ask yourself 2 questions. 1, where has it come from? Has it already expended a lot of energy? Is there news coming out, and it's the new release of some product, and it's already up 8 points in the last 3 days? Where has it come from? And because that tells us where do we put our stop? Is there a level, a close by level that is kind of our line in the sand where we say if it gets below that, well then I'm out. So you can identify what your risk is. If it's if the stock is shot straight up and there's no real good level of support, you got to say, well, it could pull in real hard here. It's getting a little extended, so I, maybe take a small position instead. And the second question is, where does it have the potential to go? If this stock does do what I expect it to, if Dendrion breaks past 29.55, what's the potential upside in this thing? Well, it's got a big short position in it. It's up, close to all-time highs 3 days ago. Now it's at all-time highs. I mean, the sky's the limit, really. So you want, all-time highs are great because there is no prior resistance. There's no one still stuck in it from even 2. You look at a weekly chart and you say, well, it's breaking out. Here's a good example. So info space, you look at this and you got a nice looking weekly chart here where the stock just broke out on this weekly time frame on big volume. Where's the potential resistance? Well, it got to it. Now, did it encounter resistance here because there's still people from July and August of 2008 holding the stock that are saying, cool, now I can break even? Probably not. I mean, maybe there is. I don't know. But I know no one in this room thinks like that. But it becomes, when everyone looks at the charts, they say, well, where does this have the potential to go? Well, it had prior resistance there. So as it starts approaching that level, let's back off the gas, stop buying and then other people say, hey, it looks like it's up to that level, let's start selling. So a lot of technical analysis tends to be that self-fulfilling prophecy, which is cool to, it's good. I mean, it gives us, some logic, but the key is to understand what is the psychology behind that. What are the bulls, the bears, and those in cash? What are they doing? What are they thinking? How would you feel if you were long from back here? Or how would this big institution feel that accumulated a shitload of shares down here? It gets real extended. They say, hey, let's feed some out, But now you look at this stock and it's broken out on big volume. It's consolidating. We've got a rising 10, 20, 30, 40 week moving average. So the weekly time frame looks nice. Then we look at the daily time frame. It gapped up here on earnings. Their revenues, and I don't know this for many companies. I just happened to look the other day because I was bored. But their revenues were up 92%. Their earnings were like 28 cents versus 14 cents last year, and an estimate, or versus a loss last year, and an estimate of 18 cents. So they're selling more info spaces or whatever the hell they sell. Right? They're selling more stuff, and they're making more money doing it, and they're making more money than the analysts, the so-called experts, expected them to do. So if you ran a growth fund, what stock would you buy? Would you buy this? I mean, you'd obviously own Apple. Would you be buying Citibank, or is this a more likely candidate for your growth fund? This is the type of stock. So, it pulled back hard, but it got to that 50-day moving average. So you start to look at the shorter term time frames, 30-minute, a 10-minute, and now it's starting to look like, to me, if it this has been an important level. I don't like the fact that it ran up all at once like that here late in the day, so I wouldn't necessarily be looking to buy it on a break above whatever that's, let's call it 1025. Instead, I'd look to, okay, maybe it can pull back slightly, touch on that 5-day moving average and hold. Maybe we also have tomorrow's daily pivot near that level. So this would be maybe a candidate to look at and say, if it pulls back down there and finds some support on a 1-minute chart and then rallies back above the daily VWAP, I'll give it a shot with a stop of whatever the low was that day, and then add to it as it breaks above this little resistance to it level, and maybe even break, add some above this, because there's a bunch of geeks that look at charts and say, hey, that's a cup and handle. What's the psychology of a cup and handle or an ascending triangle? The psychology is more important to understand than just recognizing this ascending triangle, right? The psychology here of an ascending triangle is we've got resistance, and we've got the stock that's pulled back. First, maybe it pulls back from, let's just call this 20, it pulls back to 15, and the buyers retake control. It rounds back up to 20, and there's still supply there. And the supply says, hey, come take it as much as you want. We got it here. So the buyers still go, let's back off a little bit, pull our bids, let's not buy the offers. It pulls back, but this time it pulls back, and the buyers say, all right, it's 18, I like it. Let's go in, let's put some bids in there. So they're taking control not at 15, but 18. So this first one, it ran up, it tested that 20 level 8 days later, then 5 days later. Then it pulls back and the buyers take control at 19. So they're getting more aggressive price-wise, and it's testing this level of resistance more frequently. So instead of 8 days, 5 days, it's 3 days later. It's building pressure by working through that supply. And eventually, the groups of people, or whoever the seller or sellers are, they run out of supply, or they say, hey, these guys are stubborn, they're persistent, they keep coming back. Let's lift our offers, let it run a little bit, and make some more money off this thing that we want to sell. So it's just the pressure building, and it's people look at it and they have no clue what is a cup and handle. They have no clue what is an ascending triangle, but they can look at them and recognize them. Any monkey, you can train a monkey to recognize these things. But what's more important is what it tells you about the behavior of the buyers and sellers and the supply and demand and how it's changing and the imbalances. And then that's the point where you anticipate, and just going back to this info space, you anticipate, so this one looks like a good candidate, anticipate a scenario. Not, am I going to be the dumbass that buys it as it breaks out and then it's going to pull right back in? Because it's already it's just run from 990 to 1020 here late in the day. It had a 3% rally in the last half hour of today's trading. There's got to be some little bit of profit takers in there. So you anticipate these scenarios. What if it gaps up? How am I going to handle it? What if it gaps down or just pulls back down? What's the volume telling me? And that sort of thing. So the fundamentals, it's got a good story. Big deal. So what? There's a lot of good stories out there. But if it starts to rally again, then maybe you look at the weekly time frame and say, hey, you know what? That could be a good one. I mean, we'll see. Who knows? But where does it have the potential to go? So where has it come from? Well, it's just expended that energy. So I'd rather see that if this was today's close, that it pulls back a little bit and then begins to rally. And maybe I'm going to buy it right as it begins to rally right here. And then hopefully we're going to see a nice pattern of higher highs and higher lows. And then it breaks past these levels on the bigger time frames and brings more, bigger institutional money into it, thinking, here it goes. We got to get involved now before it's too late. In anticipating where that momentum can come in. So it's the basis of basically a risk reward. And I like to call it the theoretical risk reward, because the risk reward, everyone says 1 to 3, but it's garbage in, garbage out. You can say the Investor's Business Daily says, I think buy at a pivot and risk 6%. or some 8%. I don't know what it is, but it's an arbitrary random percentage number. It's not based on what we're trying to do. We're trying to enter a trend. So what's the definition of trend? Higher highs and higher lows. So if we're buying at that first higher high, our stop should go below that most recent higher low, because breaking below that invalidates this definition of trend that we're trying to grab a hold of. So we can even anticipate it and lower your risk more and more. There's it could be 10 cents, it could be a nickel, and if you get it at the right spot, when those are everyone does. You love it when you're the guy who actually breaks the stock out. When we're a good environment and you see it at that level and you see the speed of the tape building, and you know that it's got this resistance level at $29.50, and you feel it building, and you're like, all right, I'm going to go in, I'm going to take the offers, and hopefully the offers are true, and there's not this big iceberg there, and I'm the guy thinking he's a tough guy breaking it out. But anyways, that's just so what's the theoretical risk reward? Because it's just based on our analysis, and the market doesn't have to agree with our analysis. It's what we think. It's our subjective view of what we're seeing on that chart. But if we can, again, just not recognize the patterns, but the psychology, and use that in helping determine what the most likely scenario is, then it's just a more well thought out plan than what our competition is doing, and we've got a better chance of having a better outcome. So the way I like to look at trend alignment is to look at a couple time frames. As I've said, look for a stage 2 trending stock. You want to look at a daily uptrend and say, okay, that's a good buy candidate. Now let me drill down to that secondary trend, like Charles Dow said. So look at that 65-minute chart, and you want to look at that and say, what's the trend in here? If we've got this uptrending stock that's just pulled back, short-term stage 4 downtrend, we don't want to buy it on the way down. No one in here wants to buy weakness as it's declining, or maybe you do. I don't know. To me, it usually doesn't work. Okay, let it settle in. Let the institutions do the dirty work of accumulating it and taking the risk and putting themselves at risk. But and then we want to let it accumulate. So we want to let the risk of price movement move against us. We want to sit out while we have the risk of price movement. Then it will go into a short-term accumulation, and what we want to do is, during that accumulation period, that's when we want to really start to stock that stock, like stocking, the info space, and say 1025 looks like a level, but I'm not going to be the dope that buys it there. A better scenario, lower risk scenario, and start to anticipate these in the stage 1. That's where you're stocking it, and then as it breaks into that stage 2 on the short-term time frame, that's now in alignment with the daily uptrend. Well, the sum of the rallies is always greater than the sum of the declines, obviously. So we want to have a long bias in an uptrending stock, and the long-term trend is just really the sum of all the short-term trends. So the short-term trend really leads the long-term trend. You're going to see the higher high as it breaks past that $10.25 level tomorrow, before you're going to see a higher high in the daily chart, of course. Okay, but that's where it all unfolds. People who look at end-of-day candles and say, "Hey, it was a doji," or whatever, it looked like a dead day. No, dude, did you see what happened with that doji? We shot up on the open. We midday we went sideways, and then we caved in. Yeah, there's your doji, dude. It was just, you got to look inside, more deeply. And then, you're looking at your 5, your 10, your 2, your 1 minute charts to really fine tune your entry. And that's when I'm not going to talk about tape reading, but that's when the tape reading really comes in as well, because that's where you start to look at the speed of the tape and the what's it doing. So you want to look at their buy candidates on I've got a daily chart here, and then I've got a 10-minute time frame of that same stock, and then here they are side by side. So we've got this green boxed in area is this area on the right. So the low of 32.40 right here, and this pullback to 32.80ish, and this high up at 34.8. So we see the higher highs and higher lows. So if we're seeing this breakout, and we see that we want to plan in here, we want to buy as it rallies. We want to hold these, and I have these circles just to show you. It's indecision when the moving averages cross, and that's often meaning that the stock is going to need to at least consolidate a little bit through time. The easy money of this rally's most likely been made. Start moving on to the next idea. It's just the opposite in a downtrending stock. We want to look for a stock, a short candidate. We want it in a downtrend to begin with, and then we want to look at it and say, if it just got hit, and we missed that first decline, okay, well, it's going to then start to accumulate. Then we're going to get that little bounce in the downtrend, okay, and let me I'll just pull up a chart. It's easier. What was a good one? Was OPO. Is there one here? Well, let's just say the IYR last week. We've got this, so let me take a look here. So let's just look at, I guess, like this day, for instance. Okay, so we're in a bigger downtrend, let's say, and we've got the 5-day. I'm just going to make this scenario up because I can't use the keyboard, but that's all right. It doesn't matter. I can make the point. We're in a primary downtrend. We want to avoid this stage 2 markup. It distributes a little bit and then breaks down. We want to get short on the breakdowns. This isn't the best example, but the point is that it's just the opposite. What we want to see is a stage 4 decline, and then on a 10-minute or 30-minute time frame, we want to see accumulation. We see that low volume rally. We don't want to. You can make money, no doubt. You can make money buying those stocks in downtrends. Okay, but again, the odds aren't there because the news is probably bad, and news and surprises follow the direction of trend usually. And you've got, the sum of the declines is going to be greater than the sum of the rallies. So there's less opportunity on a mathematical basis. So we want to avoid that uptrend, but when it starts to distribute, if it rallies up on that late volume, starts to distribute, then we want to start watching that and anticipate the breakdown. This is where we plan it. We want to anticipate all potential scenarios and then wait for price confirmation before we participate and enter that stage 4 on the short-term time frame. And as it gets hit, ideally we want to hold it as long as we can, as long as the stock continues to decline. So here we've got this stock kind of magnified there, beautiful stage 4 decline. Anyway, so I'm getting near the end of this, and I'm happy to take as many questions as you guys want. But when it comes to moving averages, I talk a lot about moving averages, and a lot of people I think misuse them and misunderstand them. They look at them and they say, well, simple or exponential, whatever, dude, whatever you want. It doesn't matter. Okay, use a 47 period, exponential, offset, whatever you want. The point is, though, what do most people look at? And I forgot to ask last night, but most people, if you ask a room of 300 people, say, do you use simple or exponential moving averages? Simple, 70% of the room holds up their hand when you say ask simple, 30% does when you ask exponential. Therefore, most people are looking at the simple moving average, so that's why I use them. But they're going to be in approximately the same area anyways. They're not that far apart typically. And the point is that it's not meant to be a place to buy. It's a reference point. It's something to compare price to. It's an inflection area where it says, okay, we've got this widely watched level. As the stock approaches that, now I want to switch to a shorter term time frame and see, a pullback to a 50-day moving average. Is there evidence that the buyers are regaining control in there, or that the buyers are stepping up? Or does it look like the Qs did, and it looks like only a fool would buy here, right? So it's just to tell us what, where we are, what to compare price to. So if you're looking at a weekly time frame, this is what the institutions do. They basically, there's an institutional saying for mutual funds that the bulls live above the 200-day moving average and the bears live below it. Now, that's just the way they've been trained. That's the way they look at it. So there's enough institutions that make their decision based around the 40-week or 200-day moving average on a weekly time frame. That's generally the most important. You want to, invest in the direction of that. Now, I don't invest, and I don't think that many people in here probably do, or maybe some of you have longer-term investments. I trade my IRA just like I trade any other account on a daily time frame. A 50-day moving average on a 30-minute, 65-minute. This, to me, is the most magical moving average there is for an intermediate term, is the 5-day moving average. And again, it just requires a little, so if you're looking at a 30-minute time frame, you're looking at 65 periods. If you're looking at a 65 period, you're looking at 30 periods. If you're looking at a 10-minute time frame, it's 195. And on the daily time frame, to me, it's the volume weighted average price. Those are, you just want to trade in the direction of those, basically. You want to look at it and say it's generally innocent till proven guilty, above a rising daily VWAP, guilty till proven, innocent, whatever. Lost my train of thought. You know what I'm saying, though. Innocent till proven guilty, or guilty till proven innocent below it. Below a declining one. So that's the end of this little PowerPoint here. That's my book, and my Twitter name is Alpha Trends. So happy to take any and all questions you guys got.
I have one, Brian. So you said that you don't use moving averages to time your entries. When you're looking at like a 1-minute chart or a 3-minute chart for your entries, will you consider using those to give you an idea where you might want to get in?
Well, I'll look at them as a reference point, and I'll say, well, we're consolidating, below this, but we're holding that daily VWAP, and as this day starts moving forward, let me just get that out of the way. As we start seeing these higher lows, and we're approaching that again, you look at this and say, well, it's holding the daily VWAP now, so it's more likely, I think, that it could break out this afternoon. So it's a reference point, and the pullbacks, in particular, if you've got if you had a nice run on big volume and then a low volume pullback and it settles in right near that daily VWAP, and then as it starts to move away from that level, then I like to buy them. I use them as that reference point. I don't say, all right, the daily VWAP is $43.82. I got to stick a bid in there. I have to own VWAP, But yeah.
Okay.
Yes.
What will you look for when you're setting your stops? Do you usually use just like clear horizontal levels of support and resistance, or will you use VWAP, moving averages?
Generally, I look at what's, if I'm buying, let's say, how'd that happen? Let's just use this as an example. Let's say I was watching this pullback in here, and I decided I was going to buy right here at this point. Okay, after this little pullback here this afternoon. If I was to buy there, I would say initially, in my mind, my firm stop would be here. But if it started failing and kind of coming in back in there, I'd probably sell at least half of it, thinking, all right, it just doesn't seem like it has the momentum. I'm not going to wait to get stopped out on the balance, but I'll hold some. And then, as it begins to run like this, when you get a vertical movement, obviously it's, where do you raise your stop below? There isn't really a relevant high or low. You've got 30 minutes before the bell before the bell. So I'll just start feeding it out into strength, just arbitrarily almost. Just saying, well, it's I've got 20 cents here. I'll take some off. 25 cents. I'll take a little bit more off. All right. Well, now I'm down to 500 shares. I'll just hold in the close, see what happens. Sometimes it's just arbitrary like that. It's not. Stops are. Retail people in particular, I think, take the word stop too literally. They don't, and I see that with a subscription product that I'll say the night before, it's 50 cents away, but the next day, you don't have to risk 50 cents. You look at it and it looks retarded to risk 50 cents on something, because it had just consolidated and made a nice tight little range over the last half hour where the low is 10 cents away. And if it breaks that little range, then it's probably going to go down and hit that next level. So that's your next new little level. So it's
higher lows.
higher lows generally, yeah, exactly.
Brian, on that
you've made this point about 4 times, from which is, and I'm confused on this,
Mm-hmm.
And you've been doing this for, and the idea is you might buy something at 22.50, and you know below 22 it's no good, but you're not going to give it to below 22. Can you explain exactly why that is, and if you do get out at 22.40, what's your plan if it actually comes down to the 22 area?
Well, if it comes down, if I'm looking at it as a long candidate, I've kind of I don't like to reverse, basically. You know, when I'm looking at that swing trade setup, my mindset is this stock is in an uptrend, and you know, there's vehicles that, you know, if I'm gonna really day trade, then I'm gonna go into the IYR, the SRS, the TW, the TNA, and the TWM, you know, and those types of things, the levered market ones. So on the market, I switch intraday from long to short. On a stock, though, where I think, okay, we've got this longer term trend, and we've got 20, what I think you said 25 and 24.50. But I said, you know, I buy at 25, and I said the night before it stops at 24.50, but it drops to 24.85. It just, you know, it'll be, you know, the advanced decline line is weak. Most stocks aren't really lifting. It just seems like the general environment isn't as great as I need it to be for this thing to turn back around. So the strong defense is just, I'd rather lose 15 cents now, and if it gets down to that level, well, you know, if it never turns back around, I don't care if it gets down to that 24.50 level necessarily, because you know, in my mind, it's, you know, it's that stock's dead to me. You know, it's no longer my son. So the point is that if the market conditions don't back up the case for being long, then I'd rather take the 15-cent stop rather than sit around and wait for a 50-cent loss. And instead, I'll start looking at my other list of stock. You know, I'll have maybe 15 stocks that I kind of monitor next day, and I'll say, well, it looks like the market's weakening. Either I want to get into some you know, SDS or something, or maybe I have a stock that I like as a short candidate, and it is starting to break down, so I need to focus over there instead.
Okay, so if your long candidate is looking weak, then you start to look at your short candidates?
Not necessarily just that one stock looks weak, but if I'm seeing that pattern across the board, that the market's weakening, this stock just doesn't seem like today's the day, maybe it's, you know, like on the Dendrion, I didn't wait, like I know some of my subscribers actually set the stop, and that's what I felt really, you know, badly about, is they had set the stop at that level, that you know, at that you know, that precise level. I mean, I called it perfect. For the wrong reason. But anyways, whatever that low was. So I had sold over in here because I'd seen, you know, it was strong on the open. I bought it at 55 cents, and then it was down on the day. So it was up 15 cents early on. Then it went negative. When it went, I think I took a little bit off, up maybe a dime or something, because I bought in several thousand shares. And then it broke down. I was like, no, this isn't what they're supposed to do. I mean, if they break out and then come back in that quickly, I don't need to wait for 50 cents. You know, because I mean, here, if I've got 2,500 shares, I'm not going to wait for a $1,200 loss. That's foolish, right? So
only getting back in if it breaks above.
But only getting back in, right? And then it recovered that afternoon. I was like, well, that's why I have some options, because the options cost me 45 cents or whatever, and I knew that basically it's a spec. You know, if it goes to, you know, I can ride them into the dirt, and it's not really going to hurt me. I don't want to, but you know, the options were down 30% at that point. And then the next day, when it, you know, started getting going, I actually bought it right in here. I was thinking, you know, it closed right on that 5-day moving average, starting to flatten out, and then it started getting, you know, a really nice day. So man, I just, you know, so many people want you know this, they want that literal answer. Roy was saying that too. They want that literal answer. And it's just, you know, the market conditions change. You can't say, here's what we're going to do tomorrow and expect the market's going to comply. It's just crazy. You have to, you know, again, think that those next chess moves ahead, that, you know, anticipate all potential scenarios. So if info space acts this way. Here's how I'm going to behave. Here's how it's going to influence me. So I'm not just that emotional person that sees a gap up 20 cents and goes, I have to own it. It's got that. Remember, revenues are up 92%. Well, so what, man? Obviously, right? It's a moving mechanism. Yeah.
To follow up on that, then how do you stop yourself from churning? Like, all right, so you get
Yeah.
the feeling that it's like not working out. You hit out, cut your position in half.
Yeah.
Doesn't go down to this stop. Now it's starting to look good again. How
Right.
do you not how do you decipher between getting in and out,
Well, some days I wish I don't stop myself from churning like anyone else. There's those days where it's just like, damn, can nothing go my way? I'm taking small losses, I'm being disciplined, but over and over again, the death by 1,000 paper cuts. There's those days where you didn't really do anything wrong, but you look down and you're like, how did I lose that much money? I didn't even take any big losses. I didn't really do anything, that I shouldn't have done. But I guess you can't. I don't know how to answer that because I don't stop myself. Maybe you guys. What's your guy? How do you guys do it? Does anyone have a way of not churning themselves someday? I don't think it exists.